All right, let's be real for a sec. These stock footage visuals and random images we're rolling with. They're giving major budget indie film energy, like we grabbed them from a free site and hoped for the best. Sometimes they match the vibe, sometimes it's like, why is there a piggy bank staring at me? We're total amateurs here, fumbling through this finance stuff like it's our first group project. But hey, the actual info on earnings season. It's straight fire and could save your portfolio from a plot twist you didn't see coming. Stick around because we're diving deep into how this quarterly drama actually moves the markets. And quick heads up, this isn't financial advice at all. It's just educational vibes mixed with some entertainment to keep it from being a total snooze. Do your own research, talk to a qualified pro before making any moves, and don't blame us if your stocks decide to ghost you. Picture this, one earnings report drops and bam, your favorite tech stock either moonshots or nosedives like it's auditioning for a horror movie. Ever wonder why the market suddenly flips out over a bunch of boring spreadsheets? That's earnings season for you, the quarterly ritual where companies spill their financial tea and investors lose their minds trying to sip it up. It's not just numbers, it's the pulse of the economy, and for newbie or mid-level investors like you, understanding it can mean spotting trends before they trend. So why does this matter? Well, earnings season is like the Super Bowl for stocks. High stakes, lots of hype, and it sets the tone for where the market's headed next. Earnings season typically hits 4 times a year, right after the end of each fiscal quarter. Companies from giants like Nvidia to everyday players release their profit reports, revenue breakdowns, and future outlooks. For beginners, think of it as report card time for businesses. Did they make more money than last time, beat Wall Street's expectations, or disappoint and send shares tumbling? The impact on stock trends is huge because these reports aren't just history, they're hints about the future. Strong earnings can fuel bull runs, where prices climb as investors pile in, betting on growth. Weak ones? Cue the sell-off with trends shifting bearish as fear spreads. And it's not isolated. One sector's wins or losses ripple across the board, like how tech earnings often dictate the whole Nasdaq's mood. Take context from recent cycles, tariffs have been this looming shadow, mixing things up in Q3 reports with moderate hits so far, not the apocalypse some feared. But the real juice is in the trends shaping markets, like how consumer spending fears from policy changes could crimp fintech plays. Investors are glued to these releases for clues amid economic fog, especially from banks and big names. It's why Dow futures brace up before the season. Everyone's trying to predict if stocks will keep climbing past the bad news or finally hit a wall. For intermediate folks, remember, earnings don't just move individual stocks, they're the market's mood ring, coloring everything from inflation data to overall direction. Now let's break it down further. As we look at these financial docs and cash stacks, it's clear earnings reports are the backbone of stock movement. Companies have to disclose real numbers, revenue, net income, EPS, or earnings per share, and analysts compare them to estimates. Beat the whisper number. Stock pops sometimes 5–10% in a day, creating upward momentum that lasts weeks. Miss it? Down she goes, but savvy investors watch for guidance, that forward-looking stuff on next quarter's expectations. It's like the company saying, hey, we're not just surviving, we're thriving, or the opposite, which can tank sentiment. Consider tech giants, they're often the stars of the show. Nvidia's earnings, for instance, don't just affect their chip empire. They splash into ETFs and the broader AI hype train. When they crush it, you see trends like increased buying in related stocks, pushing sector indices higher. But it's contrarian sometimes. Even if the market's climbing past bad news, a single dud report can pause the party. For you as an investor, the takeaway is to track key metrics like revenue growth year over year. If a company's earnings grow consistently, that's a green flag for long-term uptrends. Practical tip: use free tools to screen for earnings beats in your watch list. Don't chase every pop, though. Overhype leads to drifts where stocks keep moving post-report based on news flow. And yeah, while we're on these growth charts with arrows pointing up, it's tempting to dream big, but always factor in the bigger picture, like how tariffs might nibble at margins without derailing the whole ride. Shifting gears as we hand over those reports and cash visuals, the real strategy kicks in during earnings season, playing the playbook right. One big trend to watch is sector rotation. Banks kick things off, giving economic clues. Think loan growth signaling consumer health or provisions for bad debts hinting at recession risks. If banks report solid, it boosts confidence, lifting financial stocks and spilling into cyclicals like industrials. Tech follows, with names like Nike or PayPal setting paces for consumer and fintech trends. Investors fear tariff bites on spending, but so far, it's mixed and moderate, meaning stocks might keep their strong trend ahead. For intermediate investors, dive into post-earnings drift. Studies show stocks that beat tend to rise further over the next month, while misses lag. Why? Markets digest slowly, and news predicts that momentum. Track 2 key trends this season. 1. The uncertain outlook matters more than past quarters. Guidance on tariffs or inflation can override actual numbers. 2. Headline fatigue. Does the market even care about tariffs anymore if earnings keep delivering? Stocks have been climbing past noise, so focus on resilient sectors like tech winners. Example, if Nvidia and peers shine, expect ETF inflows driving broader uptrends. But if consumer names falter, watch for defensive shifts to utilities or staples. Practical takeaway, build a calendar around earnings dates. Apps make it easy. Position lightly before reports. Maybe buy calls on expected beats for upside, but hedge with stops. And for beginners, don't FOMO in mid-season. Wait for patterns. As we slap that money down on the desk here, it's a reminder. Earnings can feel aggressive, like the market's daring you to bet big but play smart. Tie it back. These releases accelerate cycles, making season matter because they validate or bust trends. If Q3's high stakes, as previews suggest, use it to gauge direction. Strong reports could extend the bull, weak ones signal caution. Looping back to those stacks of reports and graphs, let's hit the third main point: navigating risks and spotting opportunities in earnings-driven trends. Tariffs are the wild card. Early Q3 data shows mixed impact, mostly moderate, but on consumer spending. That's where fears hit hardest, especially for fintech like PayPal kicking off reports. Investors are seeking clues from banks amid data fog, so watch credit metrics for spending health. If tariffs begin to bite in Q2 previews, expect volatility, but so far, the market's shrugging it off, keeping Dow forecasts strong. Another angle, ASX or global earnings add flavor with key metrics like margins revealing true health. For U.S. markets, news predicts drifts. Positive surprises lead to sustained gains. Trends to track. 1. Tech giants driving futures. Nvidia looks like a winner, potentially lifting semis. 2. Economic signals from earnings outweigh headlines. 3. The uncertain outlook. Q1 seasons often hinge on forward views, setting multi-quarter trends. For you, practical steps. Analyze beats-misses ratios across S&P 500. Over 70% beating lately keeps bulls charging. Use it for portfolio tweaks. Trim laggards post-miss, add to winners. But beware overreactions. Drifts happen because algos and retail pile in late. And hey, as we crunch those numbers on the calculator, it's easy to get lost in the math, but remember, earnings season's your chance to align with winners without guessing games. Bridge to investor sentiment with that piggy bank. Savings matter when earnings signal thrift or splurge modes. Wrapping this up with those accounting spreads and workspaces, we've covered the essentials. Earnings season isn't just quarterly noise. It's the engine driving stock trends, from direct price pops on beats to broader ripples via tariffs, tech dominance, and economic hints. Context sets the stage. 4 times a year, companies bare their souls financially, influencing everything from individual shares to market direction. Main point 1. Reports fuel momentum with metrics like EPS guiding up or down trends. Watch tech for sector leads. 2. Trends like moderate tariff hits and bank clues help predict rotations, using drifts for longer plays. 3. Spot opportunities by tracking calendars, guidance, and beats while dodging fatigue from overhyped headlines. Quick recap. Strong earnings extend bulls, weak ones pause them, but the real power's in the trends they reveal. So what's your strategy this season? Riding Nvidia's wave or hedging consumer risks? Drop a comment below, hit like if this broke down the chaos for you, subscribe for more no BS investor tips, and share with your squad who's just starting out. Keep it real out there. Markets wait for no one but knowledge. That's your edge.